mean, I think that actually the forecasts have gone a little bit too far. I mean, I do think that the US is going to be slowing down next year. You should expect that given interest rate hikes, the strong dollar from this year, and as well as the trade tensions. But then to say that we have a recession coming into 2019, I don't think there's any indicator out there which would, from an economic side, which would suggest that 2019 is the year.
Well, the flattening of the curve is what people have been pointing to.
Yeah,
typically it lags though.
And absolutely, I mean, we know that it's going to be slowing down. And certainly there is a recession in the future on the horizon. But in terms of the timeline, it seems that 2019 is a little bit too early to be worried about that. Late 2020, 2021, I think, everything is to play for that one. But for markets to be as concerned and has dropped off as far as they have, I think has gone a little bit too far.
But do you think, given the concern that is in the marketplace, it's time for investors to seriously start thinking about deploying their money into more defensive sectors, perhaps into cash, maybe go back into fixed income again? I mean, are you detecting a shift in terms of how people are thinking about 2019 and where the risk could come from?
Yeah, absolutely. So, I mean, I think that although I think that the US is not going into recession, I think there's a slowdown coming. Now, along with that, I feel like US equities are going to have a tough time next year. So we have to be telling our investors that it's time to be becoming a bit more defensive. So that means looking at more defensive sectors. It means looking at more defensive parts of fixed income as well. And actually also, from our perspective, you have to look that equities and fixed income have been quite correlated recently. So that's not giving you enough protection. You should be looking outside of that. And for us, the best place is actually real assets.
When the market is as volatile as it has been, and when I talk about volatility, what's happening is it's really intraday spurts of volatility. You get 1-2 day massive spike in VIX and then things calm down. Does it make it a trickier investment environment? I mean, are people just saying, you know what, from a risk-reward perspective, things are just too risky, underlying volatility is picking up too much, I might as well just stay out of the market for the time being?
I mean, that is increasingly a concern. I would say that, look, if we're getting closer to end cycle, these spikes in volatility is to be expected. And also remember, we're going into the holiday season, so inevitably liquidity is going to be tighter, so there is going to be those spouts. But, I think it's important to have a fundamental perspective, not just to react to kind of the day-to-day news, but have a longer term, maybe a 1 or 2 month or even like a longer bit. But responding to day-to-day events is going to be very difficult for any investor.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.